Okay, so we will go ahead to top of page 27. We have two more definitions, non-participating policies and participating policies. This goes back to what we talked about in that first section, general insurance. We said mutual insurers issue policies that may participate in dividend distributions, right? So mutual insurance companies were owned by who? Stockholders or policyholders? Answer is policyholders. And if the mutual declared a dividend, it was paid to the policyholders. So we said earlier, mutual insurance companies issue participating policies. Well, here's the definition right there, second paragraph on page 27. Participating policies, highlight last sentence in that paragraph. As we said earlier, dividends cannot be guaranteed. And then we go first paragraph on the page. We said stock insurers are owned by who? Stockholders or shareholders. Pay dividends to who? Stockholders or shareholders. So the policies that are issued by stock insurers are referred to as non-par or non-participating. All right, third paragraph down on page 27. Now, right at the start of the section, pretty much, we went over the difference between fixed and variable products. Well, here's a little review here. So in the third paragraph down, the second sentence in the first paragraph, their cash values are invested in the insurer's general account. Maybe a question on that. That's for fixed products. In a conservative fashion, since the insurer bears the investment risk. Example, whole life policy guarantees 4% cash value, but general account earns 3%. Insurer must make up the difference. So remember we said in a fixed product, the investment risk was to who? The insurance company. Because if they don't earn that minimum guarantee, they have to make up that difference. Says in the next paragraph, however, variable products do not have a guaranteed rate of return, nor do they have a guaranteed cash value. Cash value in variable contracts is invested in the insurer's separate account, which you need to know that term, similar to a mutual fund. Since there are no guarantees, the insured bears the investment risk. So here's all the stuff we talked about earlier. Next paragraph, as a result, variable life insurance and variable annuities considered to be securities and are regulated as such. So we said variables regulated at the state level as insurance products, also federally by the SEC. Goes on to say clients purchase variable products to hedge against inflation, to try and keep pace with inflation as inflation goes up over time. Okay, then we see the next setting, premiums. We have, of importance of the exam, gross premium and net premium. So you need to know, sometimes they ask about what the calculation is to calculate gross annual premium. The first paragraph highlight the second sentence, cost of death, which is also known as a mortality expense, plus expenses minus interest equals the gross annual premium. Now in the next paragraph says net single premium is an initial participating life policy minus policy dividends when the insured applies such dividends to pay part of the policy premium. So that's the net single premium related to a participating policy. Producer responsibilities at the bottom of the page. We could go on ahead to the next page on page 28. So we're talking about when you're acting as a producer out there marketing and selling insurance products, what are your responsibilities? Well, top of page 28, the first paragraph, when you are out there soliciting insurance, life insurance, you have to give all prospective life insurance purchasers a buyer's guide and a policy summary. Highlight, star that. It says prior to accepting the applicant's initial premium. Okay, so you've got to know that. Second paragraph says the purpose of these forms, their disclosure documents, they go over everything related to the policy. We can go ahead down to the bottom of the page where we have this next setting, field underwriting. Okay, we have the entire contract clause, which we'll see a number of times throughout this course. But the entire contract clause goes back to the legal concepts we talked about earlier in that first section. Now, entire contract clause states the policy when it's issued plus the application plus whatever's attached when it's issued is part of the contract and is contestable in court. So is the insurance company required to attach the policy when it's issued? No. Do they? Yes. Why? Because if they don't, it is not contestable in court as part of the contract. So that's why when you receive your policy, the application is always attached so that they could use it if they ever need to contest something in court. Second paragraph from the bottom says the application is the underwriter's main thing that they look at for underwriting purposes, but there's also a producer's report right on the application that asks questions directly to you. we said the applicant, the insured, and the producer all have to sign the application as before it's submitted there. Now, some other things the underwriter's going to do, they could possibly request that the person have a physical exam done. Okay, that's true. They might do a credit report. Now, if they're going to do a credit report, they have to follow all federal guidelines under the Fair Credit Reporting Act, which you'll learn about in law. They might do an HIV test. So let's see if we have any information on this on the next page. Not quite yet, but we will soon. Now, on top of page 29, it says in the first paragraph, mode of payment is mentioned. It says the applicant has the option to select mode of payment on the application. Mode of payment is just how frequently you pay your premium. So no big deal there. Second paragraph says who has to sign the policy or the application, as we mentioned there. Center of the page, we have the fourth paragraph down, conditional receipt and binding receipt. Okay, this is a concept you might have questions on your exam, so we need to understand how these things work. Now, I want you to know, usually, life and health agents do not have the authority to issue binding receipts. A binding receipt creates immediate coverage. No, it's unconditional. So, what we'll talk more about for exam purpose is the conditional receipt, because usually life and health agents will have the authorization to issue one of these. Now, here's the application. Down at the bottom of the application is the conditional receipt. Now, it's a receipt though. So, it's never given if the applicant hasn't paid the initial premium. Okay, so we'll say, I come out to see you, and you're in this really nice office building, and I want to buy some life insurance. So, we'll say, it's today's date, whatever today's date is, and I pay the initial premium, fill out the application, everything looks good to you, I'm young, I don't want a whole lot of life insurance protection. So you issue me a conditional receipt. So you just tear that off and give it to me. Now, in the conditional receipt, it will state either there are no conditions to satisfy, meaning I'm covered immediately, or there are conditions to satisfy for coverage to be effective. One of those conditions being possibly I have to go pass a physical exam. And only if I pass a physical exam will my coverage be effective. Okay, so let's say that I go do this, okay? I fill out an application, you give me the conditional receipt, it says there's no conditions to satisfy. And I do this 1/1, so January 1st. I die January 2nd. Am I covered? What do you think? The answer is yes, I am covered. Now, how about this? Let's say that there were conditions in the conditional receipt, and the conditional receipt stated that I had to go pass a physical exam in order for coverage to be effective. So I go and do a physical exam on 1/16, and I pass the physical exam. When does coverage become effective? 1/16, when I satisfy the conditions. Previous example, when there's no conditions to satisfy, when does coverage become effective? The 1st, when the conditional receipt was issued. Okay? So that's how conditional receipt works versus binding receipt. Now, did you know that you can actually backdate coverage up to 6 months to obtain a lower age for life insurance, for premiums? So to save age, they call it. So you'll see that in the next paragraph there. That's true, you can do that. Third paragraph from the bottom talks about replacement. Okay, here's replacement. Somebody has a life insurance policy. You come to meet them, convince them to cancel their life insurance policy and buy a new one from you. That's a replacement transaction. On the exam, you have to follow replacement procedures, which a lot of times this stuff is explained in the law section, because a lot of times there's a lot of laws. But there's disclosures you have to give out. Person has to sign off on a form understanding they're replacing their current policy. It's very important, though, because they might have a claim in the new policy you sell them that would have been covered in their old policy that's not covered in their new one. So this is a kind of a hairy situation where you might have an errors and omissions claim if the person comes back and says, hey, I didn't want to switch into this new policy, you convinced me to do so. So you have to have these disclosure documents signed off on. So second paragraph from the bottom, it's not illegal. Replacement is not illegal as long as all the guidelines are followed. However, replacement to the detriment of your client, meaning I don't care if it's in the best interest of my client, I just want the commission. That is illegal, and it's called twisting. And we'll see that later in the law. Last paragraph says, insurance underwriters rely heavily on the producer as a frontline underwriter. Why do they rely so heavily? Well, in most cases, the producer gets to meet the applicant in person, and the underwriter doesn't. Okay, so you're a frontline underwriter as a producer. You help the underwriter establish the risk. Now, here's a question though. Who determines the person's rate? Is it the producer or the underwriter? That's going to be the underwriter, right? Works at the insurance company, paid salary. They just evaluate risks all day. They're going to make the ultimate determination and what this applicant's going to have to pay for their coverage. Okay, we go on to the next page, page 30, top of the page, we have delivery. Okay, so we have in the first paragraph, they talk free look. All right, well, what's a free look? A free look is your refund provision. Now, when you buy your life insurance policy, from either the date it's delivered, if hand-delivered, or the date it's mailed, this free look period starts. It's a certain number of days. Okay, so whether it's 10 days, 30 days, just depends. And you'll see that again in law as well, how long that period is. But it's the only period of time you can return your policy and get a full refund. Okay, the free look period. So it's your refund provision, so you've got to remember that. Second paragraph, they mention what's referred to as a collect on delivery submittal application. Now, back to our example on the board. Say that you come to see me at my home. Okay, I want to buy life insurance. I found your ad on the saw your ad on the television or in the newspaper, and I want to buy some life insurance. So I call you up, say, hey, I need some life insurance. And you say, okay, Scott, well, I'll come out and see you, this weekend and get you all set up. So you do. Come out to my house. It's Sunday morning, and I'm doing my usual routine. I'm drinking my morning vodka and watching cartoons in my underwear. Okay, this is what I do every Sunday. So you're a little surprised. I go get my robe on, come back out, say, hey, come in, I just cracked the bottle of vodka, haven't started drinking yet, so I've got legal capacity, right, so I can enter into the contract. So we go inside, and you bring out the app. You have me fill out the application. We'll say that I am age 46, and I've had a heart attack. Well, let's use HA for that. And in fact, I've had two heart attacks. And I want $5 million of coverage. Now, you're thinking, wow, that's pretty good, because $5 million, that's going to be a big commission on the sale, right? However, you're a little worried here, because I've had two heart attacks. And remember what I said? I was just about to crack my vodka. This is Sunday morning at 8 o'clock. And I'm here watching cartoons. So I offer to pay the initial premium. I say, hey, I've got my checkbook. I'll just cut you a check right now, and you can give me a conditional receipt. And you say, well, Scott, why don't we wait? I want to make sure that it goes through the underwriting process, and the underwriter approves you. So hold off on that money. I won't give you a conditional receipt, because remember, we don't give those unless we get the money. I will submit it to the underwriter, and if it gets approved, I'll come back and see you, and then I'll collect the money at that point. Okay? Called a collect on delivery submittal application. So you submit it to the underwriter, and to your disbelief, it gets approved. And so you come back out to see me Sunday morning. This is 5 weeks later, and there I am again, just cracking the bottle of vodka, watching more cartoons in my underwear. And you say, hey, Scott, I got good news for you. Policy got issued. I say, okay, well, what are you here for? And you say, well, in order for coverage to go into effect, I need two things. I need, number one, the premium, and number two, I have to obtain from you a sworn statement that states that your health has not changed from the date we took the application until now. This is called a statement of continued good health. I say, hey, no problem. So I write you a check, I fill out the statement, and we're good to go. So I'm walking you out of my house and showing you the door, and you hear this little gurgling noise, and you think it's one of those really cool little fountains I have in my house, and you turn around, and I'm grabbing my chest, choking. I'm having a massive heart attack, and I die on the spot. Am I covered here? Yes. Well, collect on delivery, submittal app, you have to get two things in order for coverage to go in effect. And you did. Premium, health, signed off on it, was fine. Okay, so coverage would be in effect at that point. Now, change it around and say, you come back to my house, my wife answers the door and says, hey, Scott, Scott's at the hospital. So go down there, see him, and he's got a checkbook with him, so he can write you a check. He had another heart attack. Well, obviously, I could do that, but you're not going to be able to get this from me because my health obviously has changed. Okay, so there's the COD submittal and kind of how that works. Center of page 30, we have individual underwriting by the insurer. Kind of goes back to what we mentioned, some of the things the underwriter is going to look at. The application, the producer's report, which is part of the application, physical exams, HIV test, credit report. Also, Medical Information Bureau report. Now, the Medical Information Bureau report's a nonprofit organization owned, operated, and created by life insurance companies to track your medical history. So when I fill out my application, they're not just going to look at it and say, I wonder if he's telling the truth. They're going to order a Medical Information Bureau report, which is like a credit report on my health. So this is reported to the MIB by my insurance companies whenever I have a claim, whenever I go to the doctor. The doctors report what I went to see them for to the MIB. And this is actually a disclosure document you sign when you go to your doctor. They say, do I have authorization to submit your information to the MIB? And you say yes, because they have to have that to submit claims to the insurance companies. Okay, so we can go on to the next page on page 31. On the top of the page, okay, HIV is a big thing. Obviously, life insurance underwriters are going to want to know about it. And when we talk about underwriting, we're really talking about an individual policy because, as we'll learn with group policies, there's not really a whole lot of underwriting that goes on there. But this is more on the individual side of insurance. But HIV, okay, so they want to know if I buy an individual policy, do I have AIDS or not? So they're going to have me do an HIV test. They have to get my signed consent before they can obtain the test. And that signed consent form, the consent form has to tell me what test they're doing and who they're going to share the information with. Okay, so they have to get a signed consent form from the applicant before they do that test. And they kind of go into this in the second paragraph on page 31. No one may require the performance of an HIV test without first receiving specific written informed consent of the applicant. So sometimes they ask questions related to that in the exam. Center of the page selection criteria. There's fair discrimination and there's unfair discrimination. Fair discrimination is when the insurance companies discriminate based on statistical data. Okay, valid statistical data. Unfair discrimination is when they discriminate based on things that aren't statistical data, such as blind people. Now, a person who's blind versus a person who's not blind, their longevity, their lifespan, is not going to be any different. Okay, so they can't discriminate based on the person's blindness. There's no statistical data to back up they're going to die any sooner than anybody else. And the bottom of the page, they have in the third paragraph from the bottom what are called participation percentages related to group insurance. So they say the group premium can either be shared by the employer and the employee, or it can be 100% paid for by the employer. And depending on how the premium is paid, the insurance companies require a certain percentage of eligible employees participate in the coverage in order to prevent what's called adverse selection. And adverse selection is when too many people that are having claims get the insurance. Or more essentially, if a person knows they're going to have a claim, they buy insurance, that's adverse selection. So the insurance companies want to prevent that. They want to outweigh the people that have claims with people that aren't going to have claims. Okay, so they have to require a certain percentage of people enroll in group plans. And you see there, third paragraph from the bottom, if it's a contributory group where the premium is shared, it's a 75% participation percentage. If it's a non-contributory where the premium is 100% paid for by the employer, it's 100% of all eligible employees must enroll. But again, we'll get into that more when we get into the group life. Second paragraph from the bottom on page 31 goes back into hazards. Moral hazard, we said, somebody lies, cheats, steals. Physical hazard, we mentioned, careless person would be a morale hazard. And with the physical hazards, we said wet leaves on the sidewalk, ice on the road, storing an oily rag in your garage. Okay, those are examples of physical hazards. Last paragraph on the page, the last sentence says the underwriter has 4 choices essentially when underwriting the app. They can issue the policy with a surcharge, issue it with an exclusion, or reject the application entirely. And we go on to the last page here in the section, and we have on page 32 at the top of the page, classification of risks. 3 different risk classifications: standard, substandard, preferred. One of those is going to get a discount on their premium, and that would be preferred. One of those is going to get a higher premium charge or a premium surcharge, and that's going to be a substandard risk. So the standard risk is going to get charged the average charge and is expected to live the average lifespan. So substandard risk might have been me back here with my heart attacks, right? Smokers, people with diabetes, HIV obviously is all going to be substandard. Average person, average life expectancy, standard risk. Excellent shape, expected to live longer than average, preferred risk, and going to be rated accordingly. Now they have on the page there at the top 2 A, B, C, D. These are the different rating, the ways that the underwriter can rate a substandard risk. And then we go to the last paragraph. It says, remember, most people could purchase insurance. The underwriter could add exclusions or charge them an extra premium or a surcharge. And that is the end of that section. So, before we get into the next video, I want you to read the next section, which is going to be life insurance policies. Very conceptual, a lot of test questions. You've got to do really well in this next part of the exam. So, take a little break after this, read this next section before you watch the video, then watch the video, and I will see you there.